We are live. Thank you for joining me. I'm Mitch Goldberg. You're watching my live stream every Monday through Thursday at 4:30 p.m. called Be the Boss of Your Money, because I want you to be the boss of your money, not the other way around. Today, tech stocks, they bounced off their lows. Are we out of the woods yet? I'm not so confident about that, but we need to regroup. We need to recharge, take stock of what just happened in the market, and make sure that we are on the right track. So let's roll the intro. We're going to get into this. It's going to be a good show. If you have any questions, I'd love to hear from you. So ask away in the comments. Words of wisdom, words of encouragement are always appreciated. And if you're watching this in the live stream, same goes for you. I'd love to hear from you. I will see your questions. I will get back to you. Here we go. Thank you very much for joining me. I'm Mitch Goldberg, your host. You're watching my live stream, Be the Boss of Your Money. We've got a couple of things to cover here. A little catch up, a little regrouping. What happened? What's next? Why is everybody all of a sudden so worried? And what's happening underneath the surface of the stock market? There are so many cross currents. It's really hard to just give you a straight up and down list of three quick things. We get those resolved and we're off to the races. There's a lot going on right now. And not only is there a lot going on, but even the things that are going on, they're spinning and spinning and spinning. And as they spin, they're like spinning off more little pieces that are spinning. So this is a very tricky market, and a couple of things need to be resolved. Now, ultimately, the key is that you have an investment portfolio that's right for you, based on your risk tolerance, your time horizon, your goals. These are things that these are very esoteric things that a lot of people don't fully grasp until they go through a tough market. Well, what's your risk tolerance? I don't know what that. I mean, you ask somebody what the risk tolerance is, it's really hard to quantify that. Well, if my account goes down 10.34%, I'm going to get nervous. At that point, it's already too late to do anything, right? You have to really know that your time horizon, the longer you have to go until you need your money back from the market, from the stock market, the more risk you could take. But it doesn't mean taking so much risk that you could lose all your money. So there is a definite balancing act here. Now, you could say, well, I'm going to go into risky securities or risky endeavors. Okay, maybe it's crypto, maybe it's work from home and stay at home stocks. And maybe the ones you picked will be great. Maybe some of the ones you picked will go to zero. So that is one way to look at risk. And if you're somebody who says, I could take some risk like that with some of my money, that's okay. I have nothing against taking a shot, a speculation, a spec, as we like to say, a gamble. That's okay, as long as you go into it with your eyes open. That's the important thing, and that you know what you're getting into. And, just yesterday I was like, there's no cop on the beat, because when you see very famous, well-known people like Elon Musk, for example, who, I think he's a superstar, brilliant. I mean, what this person has done, what this man has done, it's just incredible. But when he touts something like a Dogecoin, you don't know who's listening. You don't know the risk tolerance of the people who are listening to you. And somebody might do something that's way too risky for them, for their risk tolerance. Now, I know what you're saying. Well, these are adults. They could make their own decision if they want to buy or sell a speculative thing. I don't even know if you want to call Dogecoin an investment, because there's nothing about it that makes it an investment. The only thing that's attractive about it is it's going up. So other people see it going up. So the other people see it going up. They want in on that action. So they buy it. And it's literally the greater fool theory. Now, look, I'm not calling you a fool, by the way. Oh, Mitch called me a fool. I'm never watching him again. No, it's there's something called the greater fool theory, which means it's just selling something to the next person who thinks it'll go higher because they think they could sell to the next person because they think it's going higher. And there's a lot of that's what makes it so speculative until you get to that last marginal dollar, and then somebody doesn't want to buy it, and all of a sudden it goes back down. And what makes something an investment? If it has utility, if it generates cash flow, if it solves a problem for consumers, that's what an investment is all about. Whether if it makes money or not, maybe an investment is new and it'll make money down the road. Okay, so that's a little bit of definitions, nomenclature, things of that nature. I see some of you folks out there. Thank you for joining me. Hey, Mark, it's nice to see you, buddy. I'm really glad you are here. Thank you very much. And I hope this is a good show for you. By the way, while you're watching this, if you give it a thumbs up, a reaction, a heart, whatever, show a little love, and I'll see your name out there, and it's always more fun. So let's get into some of the things that's happening. Tech stocks have gotten absolutely crushed. NASDAQ is still up on the year. So if you're watching the NASDAQ and you're thinking, well, it's not really that far off its high, the S&P 500 is just underneath an all-time high. And even though the Dow took a nice little hit today, we'll get into this, but that's still just below its all-time high. You'd think, what is everybody so worried about? And this is the difference between diversified investors who are diversified. Now, diversification is a strategy that we use to reduce risk, but it doesn't necessarily protect your portfolio from going down in a generally down market. But it's not a strategy to earn greater returns. It's a strategy to have lower risk, which means potentially lower returns, right? So we have tech stocks got hit. You wouldn't notice it by looking at the averages because the second tier stocks that have gotten pummeled, from Zoom to Teladoc to DoorDash to Palantir and so many other hot stocks, even Tesla. Well, Tesla's in the S&P 500, but the others are not. So let's take Tesla out of that for a second. The S&P 500 has financials that have been holding it up, industrials, energy, and the biggest tech stocks like Facebook, Amazon, Apple, Netflix, Google, Microsoft. They've been holding up for the most part pretty well. Netflix is really the only one of the group that has taken a beating, but it's actually recovered a little bit today. So that's why a lot of people don't notice the carnage. So if you're working with individual stocks, your risk is higher that you're going to wind up in some of these second tier, economic shutdown, pandemic stocks that are down 40, 50, or 60%, like Virgin Galactic, SPCE, has just gotten mauled. Okay. So that's what you need to know. And this is why I always talk about risk. The good thing about being just, let's say, an index fund investor is you're humming along pretty good right now, and your portfolio is done well. And this little pullback is barely perceptible on a day-to-day basis in your portfolio. Maybe today you would have seen your overall account go down 1%. I mean, not a disaster, okay? Maybe 0.5%, 0.25%. That's just, volatility that happens from day to day. Index funds, and I think this is the biggest advantage of them. It's not such an advantage anymore for index funds to be tax efficient, because tax efficient investing is a pretty popular thing today, and it's much easier to do. Tax loss harvesting is a lot easier to do. It's not necessarily the lowest expense ratio, although expense ratios are an important part of investing. You need to make sure you're, getting what you're paying for, right? But I think the biggest advantage to index investing that people don't talk about is the regenerative qualities that index investing has. I'll give you an example. When I got into the industry, there were giants like ExxonMobil and General Electric, which, were some of the biggest companies in the world. And then around let's say around 2000, it became WorldCom and Lucent and AOL. And now we come back to today, and IBM was one of the biggest ones in 2000 and in like 1990. You fast forward to today, and it's Facebook, it's Amazon, it's Google, it's Microsoft, Apple. So it's a different group of stocks. So if you were in individual stocks and you thought, hey, I've got the biggest names, I've got the best companies, that doesn't mean you did so well. But if you're in an index, it regenerates itself and has a way of replacing the bad with better. And if not better, at least with bigger. And that is, I think, the key thing that index investing does for investors. It regenerates itself. It's a self-healing mechanism as opposed to individual stocks, which often disappear. Or if they don't disappear altogether, they fall out of investors' good graces. So if I'm thinking along those lines, then you have to say the biggest stocks today, like we always talk about, Facebook, Amazon, Apple, Netflix, Google, Microsoft. You could throw in a few others in there, okay? United Healthcare, Visa. Based on history, the odds of these mega cap companies being the biggest, best companies 10 years, 15 years from now is actually pretty low. And when clients, the people I talk to are like, hey, maybe if the market goes down more, let's buy more Microsoft, let's buy more Apple. And I'm thinking, you have enough of those. And we don't know what the next monster winner is going to be. We just don't know yet. It could be any of the companies that I named. Maybe it'll be a DoorDash or a Palantir. There's so many names to go through. We just don't know. And the odds of us picking that next one is pretty low. So why not move some of your money into something a little bit more diversified? I think it's a mistake to try to squeeze every penny of profit. The reason I look here, I keep track of the time, and I don't want to go over 30 minutes in my live stream. So don't try to squeeze out every nickel of gains that you can get from the stock market from your portfolio, because the volatility takes it away. The fact that great companies fall out of favor sometimes takes it away. Now, anyone who knows me, I really like my individual stocks, but the things I'm telling you, I'm aware that every decade produces a new set of winners and losers. And what happens is investors keep going back to what worked during the last bull market. And, it's been growth. It's been companies that have beaten earnings. It's been mostly technology. And that really accelerated since the bottom of the stock market in March of 2020. And we're finally seeing some volatility. And what's happening? A couple of things are happening. So you've got inflation starting to go up. Inflation a little bit, not a little bit, a lot of it going up, which means interest rates should be soon to follow. And when interest rates go higher, it makes expected future earnings of any company worth a little bit less. But the higher the duration of a company, I know you're thinking duration for bonds, but high duration companies are companies with very high PE ratios, because investors expect future earnings to be so amazingly awesome that it's worth paying a high PE ratio for that company now. but higher interest rates today makes those future earnings worth less. I'm going to put something on the screen for you. I'm going to put this up here. I want you to take a look, and I'll read it to you as well, okay? I'll put myself up in the corner. Actually, it doesn't really matter. So I'll just, can I put myself up on the screen? No, it's not going to really make a difference. All right, so why does rising rates hurt high-priced growth stocks? Because rising rates makes their future earnings less valuable today. Since growth stocks trade on expected future earnings, this depresses their current valuations. Let me just stop the banner for a second, okay? This depresses their current valuations. So let's get rid of that, okay? So I'm right back at you. So we've got that aspect of higher inflation expectations. We have fund flows, technology funds like ARKK, ARK ETF that we talk about a lot as the poster child of, to me, overly aggressive investors and investors putting way too much money into a single investment, thinking that they're diversified, which, yeah, there's more than one stock in it, but it doesn't mean you're diversified if all of the stocks move up and down together. So the fund flows are coming out of these kinds of investments instead of going into these investments. And the pandemic shutdown, which gave such a boost in terms of valuations to tech stocks, in terms of user growth, subscription growth, earnings and revenues growth. If the tailwind of the pandemic shutdown that favored these stocks is more or less over, then you have to consider that these stocks don't go back to their old highs. And you have to consider that the rotation of money will keep going into cyclical, economically sensitive stocks like industrials, banks, and energy and building materials, right? Consumer discretionary, hotels, vacations, that sort of thing. So that's what's going on. Let's take a quick review of a few of the things going on today. Josh, I see you out there. Thank you, buddy, for joining me. Let's take a quick gander. I'll put myself up on the screen up here as I usually do. We'll just take a look at the overall market. So the Dow is down 1.36%. So you see the number, the headline number, down almost 500 points down on the Dow. Okay. And I'm like thinking, let me see if I can make it a little bit bigger for your smartphone there. Big deal. I mean, 500 points was a very big deal at one point for the Dow, but I go by percentages, and to go up or down a little over 1%, yes, it gets my attention, but it's certainly not the end of the world. NASDAQ was barely off 9 basis points, nothing. The S&P was off a little bit. Gold was up a tiny bit. Energy was up a little bit. Yields up a drop. We're going to look at the VIX. The VIX has surged. That was just 16 about, a week and a half ago, 2 weeks ago, and now it's 21. So the VIX is going up. And I said if the VIX goes above 20, if you're a watcher of the show, that when the VIX goes above 20, stocks will start to sink faster. The downtick will accelerate. What drove the Dow down? Home Depot. Can you believe it? Finally, Home Depot, which has been like the most favored stock, because everyone's buying homes, redoing homes, this movement of people from the city to the suburbs. Millennials are buying homes, right? Hard to find a home, so people are just putting more money into their homes. Home Depot. I mean, this stock has been a huge winner over the years, but off $10 today, off 3%. Now, if I told you stock was off 3%, let's say a $50 stock going down to 48.5, you wouldn't think of it as that big of a deal. But because it's a $330, before it was a $340 stock, it looks like a bigger deal. Okay, but United Health off a little, Goldman Sachs, so the bank stocks have given some back. Boeing can't get out of its own way, which is really a big disappointment. You have just JP Morgan was down, but just basically of the 30 stocks in the Dow, 2 were up. Nike was up a drop, and Salesforce was up a drop. Nike caught a big upgrade today. Analysts expects it to rise 40% from where it is this morning. Forget the was it Oppenheimer and Company. I forget the analyst who said it. It doesn't really matter. Okay. The winners on the S&P were Norton LifeLock. This is a small cap company that finally had a good earnings report, but very small company. Air Products was up. Activision, PayPal was up. That bounced a little bit. Twitter bounced back a little bit. Decliners. Hanes Brands. I don't think Hanes Brands is really the most systemically important company in the world, by the way. But Caesars, Discover Financial over $100. That shocks me. But let's just keep taking a look. Let's go to the watch list. Corona stocks. Domino's is off. Clorox was off. Campbell's was off. But look at the rebounds. Activision, DocuSign, Teladoc, DoorDash, Peloton, Zoom. So what's happening is that investors right now are trying to figure out which one of these heavily sold off tech-related stocks are worth buying, which ones are going to be able to maintain a lot of their earnings momentum. Now, a lot of these stocks are down severely. Like if you take a look, just for example, at, let's say, DoorDash, I think DoorDash is just such a quintessential stock to look at. It hit a 52-week low today. So went as low as 114.69, closed at 124. So bounced off the low by $10, up $4 on the day. Okay. But it's down from 256. I mean, stocks cut in half. So if you take a look at these stocks, even though their growth is decelerating, maybe at some point they do become a buy. That's what investors are trying to figure out. Okay. So enough of that. So here's the end all and be all to take away from this. You have to remain, you don't have to, you could do whatever you want. Remain diversified. Make your investment decisions based on your personal finance. And I know you're thinking, well, Mitch, I'm going to buy Tesla because I think it goes up a lot. It's the car company of the future. I'm going to buy Ethereum or crypto and, Bitcoin. I'm going to buy these because, hey, I want to make as much money as possible. And that's my financial goal. Think of it like this. Those are specs. They're aggressive. They could work out incredibly well. They already have worked out incredibly well. So maybe the key for you is to figure out how much of your portfolio you want to dedicate to the aggressive type of investments, speculative investments, and limit that. That's how I think you should look at, how I advise my clients to look at their investment portfolios. Is your stock or whatever investment it is, a fund or an ETF or a crypto, whatever you're buying, is it one of the workhorses or is it a racehorse? Because racehorses are fickle. They're jumpy, they're fast, they're slow, they need a lot of care, they need a lot of patience. But a workhorse might not be the most exciting thing in the world, but they'll work consistently over and over and over. That should be the bulk of your portfolio. So my hope is that you walk away from today's live stream with that view in mind. Speaking of view, that was my overhead camera number 2, camera 1. I love these views. So without further ado, I think that's really about it today. I was going to say, where do we go from here? Well, yeah. So I guess it's not over yet. Almost over. Investors have to figure out which stocks are worth buying, which way they want to go, and which stocks they want to focus on. The economy reopening stocks have surged a lot. I'm talking about the Nucors of the world, the Southwest Airlines of the world, the Caterpillars of the world, right? They have surged in a huge, huge way. We will probably get to a point, putting on my, rubbing my crystal ball, we'll probably get to a point toward the end of the year, and investors will start to say, maybe these stocks have gone up too much, too high. And if inflation has materialized and the Fed is talking about tightening, then we have to start to consider what we're going to shift into again. Be balanced, be diversified, stay well, and I thank you for watching. See you tomorrow. Oh, sorry. Slayer 6281. We are going to the moon. I hope so. I have to get a shirt that says, the moon, the diamond hands and all that. I have to get that shirt. Okay, now I'm definitely going.